Annuities. Annuity cash flow exhibit the following characteristics. First of all, the cash flow amounts are constant. In other words, they don't exhibit any growth. At the same time, the cash flows only run for a finite period. So a good way to understand annuities is by having a look at a visual. So here's the cash flows. You can see that the cash flow amounts are the same each year, and at the same time, they run for a fixed period. So therefore, this would be considered as a 5-year annuity. Now, there are two types of annuities. The first one is an ordinary or deferred annuity. And in this instance, the cash flows occur at the end of each period. Now, tip, this would be the default assumption for an annuity. So if you're told that there's a investment that's exhibiting an annuity pattern, the default assumption is that these cash flows are occurring at the end of each year. The second type of annuity is an annuity due, and in this instance, the cash flows occur at the beginning of each period. So let's have a look at an example to distinguish the difference between an ordinary annuity and an annuity due. Suppose that an investment pays $500 per month over 4 months. At the same time, the required rate of return is 9% compounded monthly. Now, in the first case, we're going to look at an ordinary annuity. First, we'll draw a timeline because it's a 4-month period. So you can see we have month 1, month 2, month 3, and month 4. And for each of these months, we're going to be getting $500. So here's where the distinction between ordinary and due comes in. A month has 30 days or 31 days, whatever. So when I get $500 for month 1, am I getting it on the first day of the month or the last day of the month? Well, if it's an ordinary annuity, you get it on the last day of the month. So for month 1, the first cash flow occurs right here at the end of month 1. And you can see it's the same pattern for month 2. You get the 500 there. For month 3, you get the 500 at the end of the 3 months. And then finally, in month 4, you get the $500 at the end of that month. So then the question is, how do we find out what this cash flow stream is worth today? And this is going to be a common exercise, ladies and gentlemen, especially as analysts. We like to see what future cash flow streams are worth today, because our job is to determine what we think is a fair value for this investment as of today. So this is why we want to calculate present value. So we need our time value variables, so there they are. And at the same time, we need to distinguish what denomination of time are we using, because when you're dealing with time value, you have to specify what the time intervals are. And in this case, based on the way the data is given to us, the relevant measurement of time is monthly. So everything that goes into this framework and anything that comes out will have to be on a monthly basis as well. So here we go. Let's enter our values. So we're getting $500 per month. There are 4 months, right? And the interest rate is 9%, but the 9% is annual. So we have to express it on a monthly basis. So what do? We divide it by 12. So therefore, on a monthly basis, the required rate of return is 0.75% per month. And that's it. So once we've entered all this in, and you can see that there's our $500 for 4 months, right? And here's our 9% compounded monthly. There it is. So then we just tell our calculator to compute what that cash flow stream is worth today. And that would work out to 1963.06. At the same time, we may want to compute what this cash flow stream is worth at the end of the horizon. And this is a common approach for retirement planning. Your clients may want to know how much will their portfolio be worth on the day that they retire, which would happen in the future. So same thing, it's still a time value exercise. So we need our time value variables. And again, when you're dealing with time value, you have to indicate the intervals of time you're using. So this would be on a monthly basis. And then you enter the same values. So here's $500 for 4 months, and the monthly rate is 0.75%. But this time we're computing the future value. So the future value would be worth $2,022.61. Again, so that means if you're receiving $500 per month for 4 months, at the end of the 4-year period, it would be worth that much. But notice now that we can break this down into 2 components. We can break it down into the income and the interest that we earned on the income. First of all, the income is as follows. We were getting $500 per month for 4 months. So if you're just looking at the income and nothing else, that just works out to $2,000. But then where does this interest on income come from? This second component. And here it is, ladies and gentlemen. Here it is. Here it is. You're trying to find out what this entire stream is worth at the end of the horizon. Well, what do you think is happening to this $500 at the end of the first month? It will be reinvested. What do you think will happen to this $500? It will be reinvested. How about this one? It will be reinvested. So not only are you getting your $500, but you're also making interest by reinvesting your income. So that's where that extra return is coming from. So if my total ending value is $2,022, but the income is only $2,000, then the residual, the $2,261, represents the interest you earned by reinvesting that income. Now the second scenario is annuity due. So it's the same data. In other words, we're looking at a 4-month horizon, in which case we're getting $500 per month. But now because it's an annuity due, you're getting your $500 at the beginning of each month. So for month 1, you get it on day 1. For month 2, you get it on the first day of month 2. Here's your month 3 payment, and here's your month 4 payment. Now tip, your calculator is actually by default set up to ordinary mode. So this ordinary annuity, your calculator actually has this built in. In other words, the assumption that the cash flows are occurring at the end of the year. So if that changes, whereby the cash flow is occurring at the beginning of the year, you will need to set your calculator to begin mode before you enter these values. Because if you don't switch your calculator to begin mode, your calculator is going to assume that the $500 are occurring at the end of each period. All right. So assuming you set your calculator to begin mode, you enter the same values, because now the calculator will do the work for you. So same inputs, 500 per month. For 4 months, you're making 0.75% per month. Calculate the present value, it will be worth $1977.78. And alternatively, if you want to calculate the future value, again, you enter the same values, and now you calculate future value. But again, the calculator's doing the work for you. The calculator is already taking into account that the $500 are occurring at the beginning of the year or the beginning of the period rather than the end of the period. So you don't have to do any manual adjustment yourself. Now caution, after you've done this due calculation, you have to reset your calculator back to default, which is the ordinary mode. And the reasoning for that is because most exercises assume ordinary mode. In other words, cash flow is occurring at the end of the year. So the due is the exception. And that's where your calculator is set for ordinary mode. So when you change that mode to begin, it'll remain in begin mode unless you change it back to ordinary mode. Now on our website, I have a tutorial that shows you how to go back and forth between begin mode and ordinary mode. And you should become comfortable with it. Now note, the only difference between ordinary and due is that with the due mode, there is one extra period of compounding. In other words, earning interest. And here it is. The number of periods in which interest is earned under ordinary mode is 3. Let's go have a look. Let's go have a look. Here's ordinary, right? Now, when can you first begin to earn interest? Well, I don't have any cash flows here, so how can I earn interest if I don't have any cash flows? So the first time I can actually deposit money at the bank is right there at the end of month 1. So then how many periods of interest do you have? 1, 2, 3. So I have 3 periods of earning interest on my income. Well, how about with a due mode? Well, let's go have a look. With a due mode, you get $500 right away. So how many periods can you earn interest? Well, if I have $500 in the bank now, that's 1, 2, 3, 4. And that's exactly the point we're trying to make. So with a due mode, you get that 1 extra period of compounding, and there it is. So where ordinary you have 3 periods of compounding, with due mode you have 4 periods of compounding. So that means there's a mathematical link between ordinary and annuity. Ordinary and due. With due you get, here it is, with due you get at least what ordinary is paying times an extra month of compounding. So that is the mathematical relationship between annuity due and ordinary annuity. So then let's see if this works out. So let's calculate the present value of annuity due using the ordinary as the base. So the present value of ordinary was 1963.06. So we just compounded by 1 period, and remember the period here is a month. So you compounded by the monthly interest rate, and you can see we get 1977.78, and that's the exact same number that we got by calculating present value of a due manually. How about future value? So to calculate future value of a due, remember the only difference between due and ordinary is this 1 extra period of compounding. Doesn't matter if you're calculating PV or future value. So with future value, we take the ordinary future value, and then we just compound it again by 1 period. You could see the factoring is the same, 1 extra period. And then you get 2037.78, and that's the exact same answer we got by calculating annuity due directly. Therefore, a due stream will always be worth more than an ordinary stream. Why is that? As we demonstrated with a due, so whether we're using that logic or whether we're doing that algebra, with a due, you get that 1 extra period of earning interest.